Hello Africa, welcome to Investments for Impact, a Villgro Africa podcast. In this season, we are focused on the topic of fundraising. Welcome to our first episode on the overall status of investment in Africa. I will be your host for this season. My name is Moses Waweru, and I work at Villgro Africa as a senior program manager across different areas: portfolio management, M&E, and fundraising. And I have two guests today who are experts in our topic today, which is fundraising. And I will allow them to introduce themselves. So Wilfred and Steve, please go ahead and introduce yourselves.
Thanks Moses, for having us. It's a real honor to be on this panel. I've been looking forward to it. And my name is Wilfred Njagi, co-founder CEO at Villgro Africa. I've been in the social impact investment space for the last 10 years, going now 11 years. And looking forward to this discussion. Hopefully it's going to be enlightening and we're going to elaborate some of the issues in investment.
Thank you, Wilfred. Steve?
Yeah, so, sorry. My name is Sewu-Steve Tawia. I'm originally from Ghana, and I'm the current managing partner for Jaza Rift Ventures, a health tech, medtech, and biotech fund based out of Nairobi, Kenya. I've got more than 20 years experience in various capacities, from an angel investor to a development finance professional, and also in trading and consulting in past careers. Thank you.
Wow, thank you guys. We have a power-packed panel today, and I'm sure it's going to be a wonderful, engaging discussion. Mm-hmm. So to start us off, I would like to ask both of you to just speak a bit to the African startup fundraising landscape, just as your opening statement.
Yes.
Yeah, shall I start?
Yes,
okay.
Please.
So I think one of the things that is quite interesting for the last, I would say, 4 years about the landscape is that there has been a lot of hype and interest in Africa. So what I usually say is that Africa is literally the last investment frontier, where a lot of the technology advances, opportunities that other regions have witnessed are really coming up now. And I would say Kenya in particular has really led the way with, Safaricom, Vodacom creating M-Pesa, and it's really created the opportunity for people to be interested in innovation on the continent. I would say that over the last 4 years, there's been an acceleration of funding to the continent to the point that last year, about 5 billion in equity was raised. And I would say 6.5 billion in equity and debt, according to Big Deal Africa, Brighter Bridges, and Partech, for instance. Beyond that, one of the things we are seeing is also that 40% of those funds that were raised were targeted to fintech, financial technology solutions, because a lot of investors believe that that's the backbone of a lot of the economies, which is pretty understandable. The next biggest area has been what people called energy, climate tech, clean tech, and related, for probably about 20%. And then beyond that, it's true that logistics, e-commerce, etc., have also taken and have really piqued interest of investors. If we go back closer to what we are looking at, which is healthcare across the continent, unfortunately, consistently has been neglected at, I would say, 3 to 4% of the total fund raised. And we're hoping that, a combined effort will change that perspective.
Thank you, Steve.
Yeah, for me, having lived and worked in India, in the India startup ecosystem, it's like watching a movie now a second time, because 10 years ago, India would have been slightly ahead of where we are today in terms of investment capital. But then the first generation of entrepreneurs there, the founders of companies like Infosys, people who built companies on the first tech boom, now became the investors, angel investors running their own funds, and increased available capital to startups. Today, as we speak, India is easily doing anywhere between 60 to 100 billion in terms of investment capital to startups. So maybe 20 times more. And it's because there was enough successes, there was enough exits, which attracted even more capital. And these serial entrepreneurs went on to invest with the next generation of entrepreneurs. And I hope we'll see that here in Africa in the next maybe 5 years or so, where these companies we've been working with now get exits. Those founders give back by either investing, mentoring, coaching, starting own funds to invest. Because as we speak, if you look at the global VC landscape, we are still a drop in the ocean. We are quite insignificant. That number, 5 billion, sounds big, but if you look in the global scheme of things, there's a long way to go. Yeah.
Thank you. I like that Africa is the last investment frontier. And I also like what you said, Wilfred, about how you can see India happening here in Africa. And I like that because it's this idea of South-South cooperation. We have really a lot to learn from our brothers across from there. Back to you, Steve, on what are the types or what are the stages of investing for a startup in Africa? How would you map that out?
So that's a bit of a difficult question, to be honest. I mean, I'll talk about the traditional way and what actually happens in Africa. Okay, the traditional way is obviously, you get an idea, you go and see uncles, cousins, family members, and friends. So we call that friends, fools to some extent, and families that can chip in a little bit of money, $5,000, $1,000 or equivalent to support you. So that's like friends and family. The next stage is usually angel investors, which are really usually people maybe you work with or related to you in one way or the other, who believe in the idea, or not related to you, but still believe in what you're building. So I would say friends and family, and then angel investors, sometimes combined, those two. Beyond that, once you start having a much more robust product, where you tend to have what we call an MVP, a most valuable product, then it's like a prototype, really. Then, and when you start to present that to investors or customers, they're interested and likely to either buy your product or service. So that's the kind of pre-seed round. And then once you start generating capital or revenue, rather, generating revenue and building a customer base, then obviously you need more money to grow. And then the next stage will be like seed round. Beyond that seed, then is Series A. So there are a few milestones in terms of revenue, product, services, organization as a team that you need to go through to get to, I would say, Series A. Typically speaking, between friends and family and Series A, you would do a different instrument that are much flexible for you as an entrepreneur, which is what we call either a SAFE, simple agreement for future equity, or convertible note. Essentially, that helps you to finance yourself today without formally giving shares of your company until you get to usually Series A, where a lot of the investors in Series A are more what we call institutional funds, meaning people raise money from third parties to invest. And these ones, generally speaking, want to have what they say a clean shareholding structure. So they'll rather invest in shares. So that, therefore, all these instruments will be converted. So you go from friends and family to people you don't really know initially, angel investors, to pre-seed investors, which are more serious investors who are much more organized, to seed ones. And then when you get to Series A, these are usually serious investors that have institutional funds. That's kind of the stage. Beyond Series A, what we call Series B, Series C, and so on, which are much later stage companies. And what I would say, generally speaking, with Series A is that you're supposed to have cash flows. You're supposed, even better, to be profitable, which changes a bit of the mindset from before, where, with growth at all costs, the tide has turned, where people are much more focused on profitability, unit economics to really grow. That is the standard. Now in Africa, it's much more difficult to find local investors. I think it's getting better. Let me put it this way. It was very difficult like 5 years ago to find anybody willing to go beyond buying second property, land, car, Now, a number of, I would say, younger generation professionals are willing to put, $500, $1,000 into a company really to support. So there's been a democratization of access, to deal flow, but also access to local investors. We still obviously have a long way to go, as Wilfred was saying, that we need more successes to drive more investment by successful people. So I would say the difference between, the rest of the world and emerging market like Africa is that there's a much more difficult access to local investors because they have other opportunities to generate less risky returns, like government bonds, land, and properties, than investing in a startup. But the mind is changing. A lot of people are really starting to understand that, look, it's not all about brick and mortar. It's also about tech and the way to also make some money, but really support the ecosystem through investments. Yeah.
Okay. So as a follow-up to that, I would like to hear your opinions on the demand and supply. Because we hear investors saying there are very few high-quality deals. And the idea here is that there is more money than there are deals. Then on the other hand, we hear startups complaining that there's no money. So could you speak to both sides? What's your opinion on what's going on?
So first, I would say it's different from country to country within Africa, number one, right? And we talk about, South Africa, for instance, is a country where there's a lot of money, probably the highest capital available in terms of economy to invest, right? But then in South Africa, unfortunately, a lot of that capital goes to a certain type of founders, right? So that argument that there's a lot of money for entrepreneurs, but the entrepreneurs on the other side, I said there's not enough capital for them. For me, it's about perception and access. What I've personally noticed is that a number of local entrepreneurs may not have the networks personally to get those type of investments. So they would apply to different programs, funds, etc., without necessarily having gotten the time to build relationship with those investors to really prove their point. I'll give an example. As an angel investor, somebody approached me on LinkedIn. I responded, said, let's meet. The person does a presentation to me at a cafe. I look at the presentation, etc., and the person asked me immediately for $50K. I'm like, I just met you. We haven't spent time together. We haven't even looked at exactly what you're doing. And I said, look, I'm not sure I can invest immediately. So they have this perception that angel investors are like in the US, where you just do a presentation and then throw money at you, right?
Yes.
So there's a lot more relationship building that is necessary on the continent, at least, to get that. So that perception, I think, is also different by sector. Okay, if it's fintech, Web3, blockchain, until very recently, it was the call of the day. So if you are an entrepreneur, you start a fintech, blockchain company, you're much more likely to find money. As I mentioned, 40% probably of the funds that were invested on the continent. If you're in healthcare, it's the other way around, where there are a number of good entrepreneurs, etc., but not enough capital interested in that because healthcare is perceived as risky. People don't know it. So it really depends on your perspective. I don't know if, Wilfred, you have similar views.
Yeah, I think healthcare, we find, as you said, only 3% of all invested capital went to healthcare. So that's quite small. And on the contrary, when you talk about human development index or human capital, it's impossible to have that without health, right? So health should be like the foundational thing that you want to invest in, because then on top of health, then you can build these other things, right? You can build agriculture, you can build fintech, you can build renewable, but then without health, none of these would even matter, right? So I would again echo that we need to see more, and you can make money in health. We've we've invested in health. We've seen the returns that it looks promising, right? Some of the investments we made 2-3 years ago have now grown like 4-5x. So you can make money in health. It's not risky, and you'll be doing also the continent a huge service, because our healthcare system is broken as we speak, right? Yeah.
Okay, I like that you brought up the subject of risk, because it's my next question. And the question is, how does risk look like for an investor? And what are the implications of that for the startup? So, Steve, if you could just speak about risk from both the investor perspective and from the startup perspective.
Okay. So, risk is, for me, according to a word by Muhi Ibrahim, the founder of Celtel, it's all about the difference between perception and reality, right? Perception and reality of risk is just the difference. I'll explain. It's an opportunity, really. So, for a very long time, Africa was perceived as hunger, famine, war, terrorism, dictatorship, etc., right? So that's the perception of risk. Now, the reality of the terrain is that we're still living. We're still having food, shelter, electricity. So if it was that bad, then why are we still here? I know a lot of people are migrating out of the continent, but all in all is the perception of the risk that has been promoting that investor risk initially, right? Things have changed a lot over the last 5 years, where you realize that actually, okay, we were being lied to. International investors are realizing that, right? When you see the CNNs or the BBC or the Economist writing, or the dead continent, or all of these things, people realize that, no. It's media that is portraying the continent that way. And I always say, until we own our own narrative, that perception of risk is not going to change, right? That's number one. Number two, those who know, meaning that, as I told you, it's difference between reality is that a lot of people come to the continent, build companies, build organizations that are very successful, which they maybe not even be able to do in their own or Western continent or country, right? So there's the opportunity set there, okay? So now what I would say is that as an investor, like any other investor elsewhere, when we look at a company and the perception of risk, we look at obviously the macro element, but also simply look, what is the team? What products, service are they doing? Is there a big market? Can they deliver on the promise to do whatever product service? And therefore, this is what we're going to back, right? So the difference really for me as an investor is, can this team execute on its promise in a market that they're supposed to know? Infrastructure challenges, we know. Electricity, power, all these challenges, we know them on the continent. They're not the same in Silicon Valley, not in Europe or Asia. But those entrepreneurs that we're going to invest in will know that, right? So that's from the investor side. What I would say is that, the younger you are as a founder, the better, because you do perceive risk. I mean, let me put it, you perceive risk differently, right? Okay. So I would say as a founder, and I've created a few companies and realized that, maybe if, being an entrepreneur is at least, at the level of customers, etc., is not for me. The risk is usually perceived as, okay, how can I, on the continent, set up a company to employ myself? Most of the time is that. So a lot of the cases, entrepreneurs start a company because they couldn't find employment. And then they set up something, at least initially, and then realize maybe they have a bit more passion, and then they create something that is much more innovative and visionary, notably in healthcare or other sectors, that they really want to change the perception of the world, right? So when you look at, as you mentioned, risk from a perspective of an investor and the other one from a perspective of an entrepreneur, I think it's really about finding your spot as an entrepreneur and finding your thesis as an investor and the level of risk that you're willing to take. If you don't want to take that many risks, take a brick and mortar company that generates cash flow. You will not get 100 or 1,000 times your return. That's to your risk level, right? As an entrepreneur, you also need to understand, okay, can you cover your bases, food, shelter? And then what can you create that makes the world different and better around you? So these are the two ways I would see it. Yeah.
Okay, great. For Wilfred, we're talking about startups, and sometimes we assume that everybody knows what a startup is. And, from my experience here at Villgro Africa, we put out calls and we find social enterprises responding, NGOs responding, all sorts of organizations. So what I'd like you to speak to is, what really is a startup and how does it differ from other types of businesses?
Thank you. That's a very good question. I'll start by saying what a startup is not. A startup is not a small business. A startup is not an SME. But actually, a startup is a vehicle to search for a repeatable, scalable business model. That's all a startup is. You're searching for a business model. You're iterating. You're testing, validating a few things, iterating until you find something that is repeatable. And then scalable. Again, scale is very important for startup. As Steve was saying, as an entrepreneur, depending on your risk level, you can go for something that is just a lifestyle business, cover your bills, be happy. But that's not what you're looking for at a startup. Scalability is key. So that's the simplest way to define a startup.
Thank you. And moving it a bit further, so what do you see as your role running an incubator in the startup fundraising journey?
Very good question. I'll go back to what Steve mentioned earlier around challenges in raising capital. One of them being relationships, right? And the other one being risk. The incubator comes in, to mitigate risk. We do what we call we de-risk. We have what we call a de-risking mechanism for startups. Think about an incubator like a nursery bed where you put seedlings and you're trying to acclimatize them there, mitigate as much. You're not exposing them to too much heat, but in moderation, and making sure that the environment is right for the seedling to germinate and grow and become a tree. So an incubator plays the same role, right? So when it comes to company risks, we have risk around the team, there's risk around the product, there's risk around the business model. Remember, I told you a startup is a vehicle searching for a business model. That means you don't have a business model yet as a startup. So our de-risking mechanism looks at how do we help you, first of all, get a business model, help you validate with customers, do split tests, try a few things, do pivots, what we call persevere versus pivot decisions. And once as you're working on the business model, at the same time, you're trying to de-risk you as a team. You're looking at the founder. What are your strengths? What are your weaknesses? Do you have complementary skill sets with your founding team? If you don't have that, sometimes we might advise you to bring in another. If you're a tech person, can you bring a business person in the team, right? So we're trying to look at all these team risk elements and de-risking them, even using things like mentorship, coaching. Again, at the end of the day, it narrows down to the founder most of the time. That's why you see several businesses might have the same idea, but one does very well. It goes down to just the founder and the execution rigor of the team. So we try to do that to de-risk the team. And then there's also product risk. And that's why we have people like now at Villgro, we have a chief technology officer who is working with the product companies to mitigate that product risk. There's a lot of issues around regulatory landscape, around safety and efficacy of the product when it comes to healthcare. You have to do all those, jump all those hurdles. And in so doing, as an incubator, we are de-risking you to a point now that you start looking very attractive to someone now like Steve at Jaza Rift, right? A fund has a mandate to return investors' money, right? Core mandate. At the incubator, you're midway here because you have things like grants. You don't have as much pressure to return money, so you can be more you can take on more risk than a fund and try to mitigate the risks of the startup to a point that they now become investable. As we are doing that, we go now to the next level, which is access to networks. Remember Steve talking about it's all about relationships. As an incubator, we've cultivated relationships with investors. As Villgro, we have about 50 investors that we have in our database that we are constantly checking with. So it's easier for us if you come to us as Moses. When we introduce you, it carries more weight than you going directly to the investor, right? Especially if we introduce you and we've already invested in you, like we have a skin in the game as an incubator. We've worked with you over 2-3 years. We believe now you're investable. When we introduce you to Jaza Rift, it carries more weight than you just going directly. So we help with the networks, right? Not only investor networks, but also now go-to-market networks, for example, in healthcare, introductions to governments, corporates, all these networks you need to succeed, right? Because one product, having a good product is one thing, but until you're able to get to customers, that's when you're able to scale. So an incubator plays that kind of a role. Yeah.
And what is it you're expecting from Steve as an investor? And going a bit further, do you feel like in this market, in this sector, are the investors meeting your expectations?
Good question. I would say it's a yes and no sometimes.
I'm all ears.
At least for Steve, he's meeting me halfway. That's why we're even having a discussion around the table. I would like other investors to do the same in terms of, if you could tell us clearly, what are you looking for in a startup? What are the proof points? What are the milestones that they need to hit so that, again, it will save us a lot of time? You tell us, I'm looking for a company that has a balanced gender, for example, female founder on the team. They have X number of revenues. Let's say they are doing annual revenues of $100,000 or more. They're in these key markets. You break it down to me like 3-4 things that you're looking for. Then that now cuts out my job. My work now is to look within my portfolio, prepare, see which ones are meeting those milestones, those proof points, then introduce them to you as Jaza Rift or any other investor. But sometimes it feels like it's not always clear. Sometimes it feels like shifting goalposts where you meet an investor today, you introduce a company, they tell you this is what you're looking for, these are the ticket sizes and all that. And you go and you prep. It takes 6 months, 12 months to prep a company. You bring it back. By the time you go there, maybe their funding mandate has changed. And you wonder, when did this happen? Or they tell you, we are not investing this year. We have actually met our quota for this year. So that makes it very painful because we've invested time and resources. I think, and what we're trying to do now with Villgro Jaza Rift is build that conveyor belt or assembly line that says, we're going to work on these few things in this early stage. We're going to make these companies hit certain targets, milestones. At this stage, after they hit that level, we're going to pass them over to Jaza Rift. And I think if we can prove that can work with Jaza Rift, we can then try to do that even with other funders. Same with Jaza Rift, because they are an early stage investor. They need also to continue that conveyor belt and look for who is the other next downstream investor who will now come and do post-Series A up to Series B. And then we could have this nice mechanism and it would work both ways. Again, if Steve finds in his pipeline companies that are too early stage for them as a fund, but they look promising, we are happy to look and work on those as an incubator. He comes to us with the findings and this is what we found about this company. These are the key risks we found. Can you mitigate, work? Can you mitigate? Then our job will be very easy. But that's much easier said than done. I don't know whether you agree, Steve.
Yeah, Steve.
No.
I was about to ask, what do you on your side as an investor see as the role of an incubator accelerator? And Wilfred has given us the theory part. So can you tell us, is he living up to his proposition? In practice, is it working? And where are the gaps and where can we improve?
Yeah, so I'll use his own answer, yes and no. So to some extent, my experience with incubators and accelerator across the continent, not just healthcare, has been kind of a mixed bag. I'll explain. I've been basically an angel investor for the last, more than 10 years now. And I've also supported a lot of companies as mentor, coach, like the Africa Prize, Royal Academy of Engineering, and many other ones. What I've noticed is that not all incubators and accelerators have the same quality, not the same standards, right?
Yeah.
So it's very difficult for me to give a broad brush.
Yeah.
But what I would say is that on a consistent basis, those that are really churning the top companies have a very structured process and a clear value proposition, right? And this is what also probably I like, not probably for sure, I like about Villgro Africa, because it's 7 or 8 years of specialization in healthcare, building the networks around the continent, a key value proposition in terms of regulatory, notably, where they have a deep expertise in bringing companies from ideation model to get them to basically all these regulatory approval, IP, for instance, product management, et cetera, et cetera. So this is one of the qualities I'm looking at an accelerator or incubator. Now, one of the key things I'm looking into as an investor is like, exactly as we mentioned before, team, product or service, market fit, and obviously the ability of that team to execute. And we've kind of summarized that as an investor into what we call the 3 T's, right? T, the letter T. It's team, terms, and taste. The taste essentially, obviously, as I said, I'm West African, and the taste is really about, it's not because you have a good onions, tomato, pepper, etc., that your pepper soup is going to be very good, because it's the way you prepare the soup, right? So it's really an idea about the way a team, a product, a service, and a market get together to create something that gets traction and what we call product market fit, right? So what I would say is that incubators and accelerators, especially incubators, solve a lot of problem around the team, for sure, right? Because they will support the team in the areas where they're weak. But the product, service, and market is a critical component of the de-risking that incubators do for me, right? Across the board. So I would say that the key value proposition of an incubator that I haven't consistently seen, unfortunately, across the continent is that they need to help me as an investor de-risk that product or service risk, especially in healthcare, where maybe you look at medtech or biotech, clinical trials or regulatory approval of devices is a critical component of the de-risking, right? Beyond that, what I would say is that more incubators need to do a lot more work in raising awareness of the companies they're supporting with investors, right? And I think Villgro is doing well. I know a number of other ones who are really building this kind of investor network so that those investors have early insight as to what teams and product or service are getting to the next level, and then really actively engage so that basically investors look at those companies early on and look at those founders hit the milestones to get to the next stage. So for me, it's really those 2 elements: de-risking product, the taste, like providing a better taste. And then, as I said, terms, etc., investors, network are the 2 points I'll look at. Yeah.
Okay.
Yeah.
So if you had a message for Wilfred, it would be the 3 T's.
Yes.
You said it's the taste, the team,
and the terms. Yes.
Wonderful. So back to you, Wilfred. Now, having been running an accelerator for several years, what would you say you have seen as the key challenges that African startups are facing when it comes to fundraising?
Good question. I think it comes down to networks. Challenge number 1. We've seen founders who have an Ivy League education shuttle into the continent and very quickly raise huge amounts of money. Yeah. And that's not bad. I mean, it's good because we still need the numbers in terms of capital, foreign direct investment. But what we find is our local founders struggle a lot. It takes blood and sweat to actually reach the next round of funding. We've had good companies in our portfolio where we gave our $50,000. They've gone on validated. They've done revenues of $100,000 annual recurring revenue. And you look at it and you're like, this is a good business. But the proof point, the burden of evidence they need to generate for investors, hopefully Steve is not in that crowd of investors, but the body of evidence you need to prove that is way higher. It's a really high benchmark compared to, I know other foreign founded companies that are making losses constantly of millions of dollars, but more and more capital is being pumped, including more and more valuations. Yet here you have a company that has been very nimble, very lean, agile. They are making margins of 40%. They're doing nice, decent growth rate. But it will take a while. It takes a lot of bidding, even from Villgro. So I think that network challenge will change if we start, first of all, ourselves investing in our own startups. Remember, these foreign funded startups, most of them come already backed by angel investors in their countries. When they do a family and friends round, it's easily $500,000.
Yeah.
While here in Kenya, if you try to do family and friends, you'll be lucky if you raise $10,000, right? So the onus is back on us as people in the continent to really believe and invest in the startups, including successful founders in the continent investing more, because then at the end of the day, all we need is money. It doesn't matter where it's coming from, whether it's VC or family or friends. And as you get that initial money and you start getting your initial traction, now you've overcome the second challenge, which is market growth. Remember, the most important capital to a startup is not VC money. It's actually customer money, which is revenue.
Absolutely.
Right? If you are doing revenues of $500,000 annual recurring revenue, all these investors will be lining up to invest in you, right? So how do you use the little initial funding from incubators like ourselves? But then also, how do you craft go-to-market strategies that allow you to actually hit that trajectory? And I see that in our portfolio, once you reach, I think $100,000 is a magic number. Once you reach that as an annual recurring revenue and it keeps growing. So next year is going to be 200, 300. At that point, it's very easy for you to raise funding, right? So those are the two challenges that I see when it comes to startups in the continent.
Yeah, thanks for that. You've spoken about an ecosystem challenge, and basically you're saying that the solution to that is more local money. But I'm wondering, from a skill set point of view, what are the skills that local entrepreneurs need to build to also help them better fundraise, like those counterparts?
Good question.
Yeah.
Honestly, when it comes to technical skills, we are as good as it gets, especially when it comes to like software type of skills. We can compete globally. I think it's more the soft skills that we lack, which you would think that they should be the easiest to gain in terms of leadership skills. Communication skills, storytelling skills. These are the basic skills that will make a difference between getting that round or going back empty-handed. So, and as an incubator and in partnership with an investor like Jaza Rift, we can start prepping. We've already started prepping some of these companies. We give feedback. We tell them, pitch to us. We give you feedback as if we are going to invest, and we tell you this is the reason why we are not investing. This is the thing that is not coming out in your business model. Unfortunately, sometimes entrepreneurs also don't listen.
I'll make more comments around that once it's done.
You found that the feedback you gave was not executed. They come back 6 months later, it's the same story, right? So this is like doing themselves a disservice, because it's not that hard, honestly. If you really follow, it's something that you can standardize, and it's a process that can be repeatable. But then it boils down to how coachable, how mentorable are you as an entrepreneur, right? Yeah.
I like that. Steve, you can take
No,
it.
I totally agree with Wilfred. Like, there's more than 5 years ago, I had that idea. So look, I've seen so many founders, very good businesses, making decent money. But the one thing was that they're not telling their stories. Like, even the website is rubbish. Like, simple website to do would cost you maximum $300 equivalent. The website is rubbish. It doesn't say anything. So I even thought to myself, look, I'm going to set up a company just to do that. Like, just to coach entrepreneur on basic thing. Pitching, website, Instagram, LinkedIn, what else? Like, even personal presentation, right? And I thought to myself, is there a business model? Would they pay? I'm not sure, right? So it's been one of the key points where, coachability of an entrepreneur and the entrepreneur's ability to speak a certain language makes a difference. And I'll make a specific comment on that. Wilfred mentioned that, I would say diaspora entrepreneurs or foreign entrepreneurs raise a lot more money.
Yes.
Probably faster. Right?
Yes.
Because from the ground up or from exposure, they've learned a certain language, a certain way of pitching things, right? We have our own culture on the continent. From one country to the other, it may differ. We have this culture of deference to, senior people and a way we do things, which I don't neglect. But sometimes it's a disservice when we want to raise and speak to a certain type of people that are outside of the continent, right? That's number one. Number two is, I also find that some of our entrepreneurs, even if you coach them, they still don't want to get there. So at some point, they need to understand, look, actually, even if I'm the founder of the company, I may not be the best one to go and pitch to investors. Maybe he's my CTO, or maybe he's my CCO commercial officer, or my chief marketing officer that would consistently do the presentations. This model of the co-founder or the founder, CEO, quote unquote, always be the pair person to be pitching does not work, right? So I think that's one of the things that a lot of our founders need to understand and need to be coached into, right? Even if you train somebody for 6 months on pitching, on presenting, etc., if they're not adaptable, it will not work, right? Right. And so that's one of the things that I want a lot of the founders on the continent to understand. On the other side, though, I think with the work that Villgro and a number of other people are doing, we can improve the way we speak to different people. So I would say, a founder in Kenya will speak to our investors in Kenya in a certain way. But when that founder goes to Nigeria, I believe that he has to be much more, he or she has to be much more aggressive, punching, right?
Yeah.
And I'll give a last anecdote on that. I personally have traveled, 32 countries on the continent so far. I have my own ranking of the most pushy of founders. Do you want to hear it?
Yeah.
It's not Nigerians as you thought.
I would have thought Nigeria.
Egyptians. Egyptian founders are on point. It's like at another level. And then Nigerians come, right? So you need to understand it's also a lot of cultural element that people need to adjust to and really get an understanding of where you are as a founder or as an entrepreneur and pitch to the right type of people that you, and also have the same language. Yeah, it's very important.
So basically you're saying, one, entrepreneurs need to be adaptable,
coachable,
coachable, but they also need to understand the context.
Correct.
So that they can apply the skills that they are learning to different contexts.
Absolutely.
But something else that Wilfred said was the presentation, the soft skills.
Yeah.
Critical.
So just very good on the hard, and the technical, but struggling with the soft. So the other thing I heard you say is strategy. Just understanding who you're pitching to and how you need to pitch.
Yep.
So moving on, I'd like us to discuss something related to this, which is what we hear from reports, what we are reading in reports, that about 92% of funding is going to just a few countries on the continent. Then we have other reports saying that 50% of the wealth in Africa is concentrated in just 5 cities. So I'm curious to hear your opinions on what's going on here. Is it that the investors are attracted by the growth in those countries, or is it that the investors are actually driving the growth? So I'd like to hear you just, answer that. And as you do that, speak to the lessons we can learn from the countries that are doing well on the fundraising side. And both of you can take that one.
Yeah, I think there's a book, I need to remember the topic, which talks about why poor countries remain poor. And they start by arguing that, in economics, we say that...
why nations fail.
Yeah,
why nations
that's the
fail.
book,
Yeah, I was looking at that yesterday.
It looks at, if you go to economics, basic economics 101, law of supply and demand, the countries that have the least capital should be the ones attracting funding, right? Because there's already a huge demand for capital in those countries.
Yeah.
But funny is the vice versa. Countries with more capital attract more capital. And that has been a difficult thing to debunk even for economists. Because if you look at any other product, commodity other than money, the rule applies, right? Whenever there's...
Rarity.
Yeah?
Rarity.
Exactly. So that's the same thing happening here. And I think it's more about pattern recognition and investor risk averseness, which says that I want to put money where there's already more money, because it means that those countries have done something in terms of maybe ease of doing business and all that, business environment and regulatory. They've done something that makes it easier to attract wealth. So I'm not going to risk with a country that is struggling to raise capital, but I'm going to pack more capital there, right? And on the contrary, money should grow highest. If you look at US, if you put your dollar in US now and don't touch it for the next 50 years, it can only go maximum of 2%, 3% a year. It will be single digits.
Yeah.
The same dollar, you put it in Kenya or in Congo, leave it untouched, year on year will grow at a much higher, it will be double digit growth on that asset. Yeah. Yet people still will not put money there where it's likely to grow the highest. And some of these countries have best resources when it comes to natural resources, even human resource. So it's something that it's something in the economics, and I'll let Steve touch about it, that unfortunately we can't do much about it. But what I would say is that I've seen startups, there is no monopoly of innovation. Let no one lie to you, right? Innovation doesn't happen in Silicon Valley or in Nairobi only or in Silicon Savannah. Or innovation can happen anywhere. Scalable innovation. And we've seen that. We've seen some good companies coming from Ivory Coast, some good companies coming out of Cameroon, some good companies coming out of any other country, right? But then they have a much tough uphill task because they are coming from a country without an ecosystem.
Yeah.
And what some of those founders are forced is, once they do their early validation, is go set up in Delaware or another place where they will attract more capital, right? Even though the idea was originally born in these countries. So that would be my submission for that.
No, there's a lot of that across the continent, and generally speaking, also across the world. You need to understand that, for instance, we all talk about Silicon Valley and Israel. All these places were bush, literally. 40, 50 years ago, there were desert for Israel and bush for forest in Silicon Valley.
Yeah.
So now, what has happened that has made those areas or countries or region that attractive, right? So when you take that and transpose to the question we're asking, obviously we're talking about the big four. So Kenya, Nigeria, South Africa, and Egypt, which are the big economy in terms of attractiveness for investment on the continent. And then is it the 5 cities?
Yeah.
So within South Africa, 2, Cape Town and Joburg, that are making the most, are giving the most interest, right? So on that aspect, it's a bit of a chicken and egg problem, right? But I think, as I mentioned to you before, it's the perception of risk for me that drives a lot of things, right? Nigeria, until I would say 2012, 13 maybe, was risk off. Too risky, too many issues. I don't want to go there. Nobody wanted to go to Nigeria to do, except for the infrastructure. I mean, the things that are brick and mortar, very simple, quote unquote, right? And then gradually, Nigerians who are in the US diaspora, or in Nigeria for that matter, starting to position themselves, starting building companies and building bridges with Silicon Valley, right? And then very quickly, they started attracting a number of investors and really changed the narrative about Nigeria as an investment opportunity. I'll mention specifically Y Combinator with Cbel. Obviously, the big startups we know, Flutterwave, Andela, etc., has changed the perspective about the investment opportunity in Nigeria, right? Funny enough, Kenya was there way before, where Kenya attracted a lot of investors before that happened in Nigeria. But progressively, because of the size of the population in Nigeria, 220 million, a lot of people thought about this huge investment opportunity, right? Egypt is 90 million people. They've a huge industrial base. They've also attracted consistently a lot of capital. But before all Egypt and Nigeria and even South Africa, Kenya was attractive, South Africa was the first destination for most of investors for a long time.
Yeah.
Anybody wanted to go to Africa, they'll go to South Africa, Joburg mostly, and then Cape Town after. So you see that the dynamics of which countries are attractive changes over time. In this particular historical perspective, you see that South Africa was one, Kenya after, and I would say Nigeria and Egypt one after the other in terms of timeline, right? So for me, it's the perception of risk that is changing from an investor's perspective based obviously on the economics of the ground, right? So, and then the other side is also, I think certain countries, especially since the advent of startup acts, trying to make the environment much more enabling and government being much more forward-looking has also changed the opportunity set for the continent. On that note, I'll finish with that. Think about DRC as a next big investment destination.
Okay, my last question. Is it true that most of the funding into the African startup ecosystem is coming from international sources?
Yes.
Yeah.
Okay. So what does that mean for us as Africans? And a quick follow-up to that, how can we catalyze local capital? Yeah, very quickly, if you could just take 1 minute each.
You want to start?
Yeah. One way to catalyze local capital, first people I would address this to is diasporans. We send, for example, in Kenya, 10% of our annual budget is from diaspora remittances.
Yeah.
It competes very highly with tourism, so it ranks up there. So that's huge. You can imagine that 10%. If we got even a fraction of that going into startups. So if you're a diasporan listening to me and you're wondering what you can do back home, other than send money to build an apartment or a house, you can put that money in a startup. We'll advise you in which startup, where to put your money. So that would be my first appeal. So then we start owning our space. Number two, if you're a diasporan, you should also return home. Yeah? I'm a returnee. I lived abroad, came back. Steve here is a returnee. Our co-founder, Robert, also returned. There's enough work to do here, exciting things that will change lives and get even better returns in the continent. So I would appeal to human capital. We have very skilled, amazing people out there. Come back, build this continent. And if you can't come back, send your money. And your money will be the continent for you.
I like that.
Yeah, Mama Africa is calling you.
Yeah.
Excellent. Thank you, Wilfred.
Yeah, I totally agree. I think in this line, it's important to organize local capital with local investors, number one, in combination with the diaspora. These are key factors. Also, our African governments, African Union, and various stakeholders need to put their houses in order, right? Because I lived in Europe, worked for the European Investment Bank, the European Commission organization. They pumped millions or billions of euros into the tech ecosystem. Even now, they've set up a 25 or 30 billion euro fund that is going to invest in later stage companies to entice them to stay in Europe instead of going to the US or elsewhere to grow. So our government need to put their ducks in a row. Thank you.
Thank you very much, gentlemen. And that brings us to the end of this first episode